So one of my very successful YouTube buddies told me to do this. So I've done a lot of shorts during this entire month. So he told me take all the shorts and put them in one long video for your audience. Most of them have more value than the ones that gets views. So this is a massive amount of value I'm giving to you, and I hope you enjoy it, and I'm just making it easy for you to run through them one by one. So hope you enjoy it, good luck, and hope you have an amazing day. Bye.
We are searching for liquidity always in the market. Like liquidity is where the strength lies. And when you start seeing that, like my mind got blown the first time I saw this when was first starting. So this is the a regular week on S&P 500. Every day has a high and a low. So what does the high do? It creates the high, right? The day after that, market opens, it takes out the high and it drops back down, and it creates a low and a high on the next day. So the next day creates a high. What happens on the day after that? Market opens, it goes out, it takes out liquidity, and it drops back down. And the next day, the same thing. It creates a high, the next day opens, it takes out the high, and it goes back down. The same thing happens with the lows and the highs. And when you start seeing this, you start having a good intuition and a market feel of where the market is going to go. Probably to the liquidity to be taken out. Good luck. I wish you nothing but the best. Have an amazing day. So there's a lot of misconceptions out there about how much you should risk and how little you should risk, and that you should risk the same amount over and over again. Let me tell you something. Risking 1%, as people say, doesn't work. It didn't work for me. So this is my suggestion if you have a struggle with risk management and how much you should risk and how you should go about thinking about risk management. So this is a chart, right? This is a chart, diagram, what do you want to call it? So our equity curve, we want ideally our equity curve to look like this. We want to have some profits and a bit of a drawdown. We want to make some profits and have a little bit of a drawdown, and it keeps going like this over and over and over again because we're using our wins as leverage, right? These periods, these are probably one of the hardest periods to face as a trader. Why? Because we usually get out of hand and it spirals from 3 losses to 4 losses to risking more, and it breaks our starting balance curve. So ideally, what do you want to do? Let's say we start with 100K in the account. So what do we want to risk? Like keeping the risk at 1%. If it works for you, go with it. It didn't work for me, and this is my suggestion of how you should go about it. Like if you start a new account, we're excited, it's new, we risk 1%, right? Let's say we risk 1%, that's $1,000. How do you make the dollar sign? $1,000. If I win that trade, I I I start risking 2%. I up my risk because I'm using my wins as leverage to get this spike up, right? If I lose the trade, I'm risking 1%. If I lose the trade, I keep risking 1%. If I lose that trade, I go back to halving the risk at half and start risking $500, meaning risking to 0.5%. And when I'm up, let's say I risk 0.5% and I'm up to my starting initial risk at $1,000 at 1%, that's a 1 to 2. Then I go back to risking 1% as long as I'm over my starting balance, as long as I'm passing the 100K mark, because I have leverage. If I'm underneath the 100K mark, I still keep the risk at 0.5% until I pass the 100K mark. This is how you do it. This is how I do it. And this is what works for me. This is the way of cutting the bleeding down. Cut the bleeding, you know. You don't want to take a loss and then you take another loss and you keep going down. This is usually what happens, and we end up on a big, like a huge drawdown that we can't get out of. This is my tip for you. If to give it a try, if it works for you, it takes a bit longer, but It's worth the mental frustrations we go through as day traders. I wish you nothing but the best. Have a good day. Done. I just met this friend the other day, and he told me that he wanna like he kept saying like I just want to make 6% a month. I just want to make 6% a month. It's like he he's brainwashed himself to thinking like I just want a 6% a month. That is it. And I asked him like, okay, fine. That it's good to set goals. Have you made 2% a month for the last 3 months? And he said no. So then I asked him like, what makes you believe and think that you want to make or you're capable of making 6% a month? Like it's like it's a fantasy. It's a great vision to have. Then again, but it's a fantasy, isn't it? If you're not making 2% a month consistently, like what makes you think like you haven't done it, that you can make 6% a month? So I asked him like 6% a month, is it hard or is it easy for you to make? Like if I just over leverage on one trade, I can reach 6%. But if you reach 6% 1 month and you're like break even the second month and you're down the third month, are you profitable? Is it working for you? Are you happy with that? Or you just take 2% each month and then you be satisfied? And don't get me wrong, like growth is good, but there's a period to learn and there's a period to stress test and there's a period to earn. Like don't jump over the learning and the stress testing part to the earning part directly because you see and get influenced by people on social media. And social media is such a it's so poisonous. It really is because you automatically compare yourself. Like, is this guy making 6%? I want to make 6%. And I told him like reflect on your thoughts, reflect on what you want to do, and have proof that you can show to people, to yourself, like have a victory list that you can show yourself that you are able to make 6% a month or 2% a month or 3% a month, it doesn't matter, but that you can do it. So your goal will be a little more realistic to you. If you have any questions, ask them in the comments below, and I hope you have an amazing day. So moving to Malaysia, Kuala Lumpur with my family affected my trading tremendously in a bad way. Why? Because I usually trade the London session and New York session, which usually opens at 9 o'clock and 3:30. In Malaysia, it was back and forth. The London session opened up at 4 o'clock and the New York session at 9 o'clock. And we have this short moment of being the most effective and being the most making great decision in that moment. So we have to be at our peak during the trading time. And if we are not that, like we make wrong decisions, right? So realizing this, like I'm more productive and effective in the morning during the day, not during the night. So this is what happened to me in Malaysia. It totally messed up my trading because the time was so skewed. If you want to know what time market opens in your country, this video is for you. So you go into baby pips, and in baby pips you just find your time zone, find which country you live in. In my case, it's Berlin. So when I write in Berlin, it automatically, like let's do another country or another country, it automatically changes to my time zone. So during my time zone, London opens at 9 o'clock and New York session opens at that time. And you can also, if you go way down, you can also see the volatility. The sessions are are higher or lower. So you can see it that in the New York session, the volatility is higher, and in the London session, the volatility is lower. That's about it. Good luck. So I wish I knew this when I first started out. So what I do during my trade and I'm waiting for my trade to hit either stop loss or take profit is to have some cards playing to play with during the time because some trades take a while. And to get myself not to focus on the trade too much, I put a deck of cards next to me and I just play around with them so I distract myself so I don't get into the emotions of being inside the trade and watching every candle move up and down because It doesn't matter because this is tested beforehand. And if it works, it's gonna work at the end. So this is my tip for you. Buy a, I don't know, $3 deck of cards and have it next to your table because you remove your hands from the keyboard and the mouse. So what is equilibrium? Equilibrium is the balance of the market. There's a premium and there's a discount. Let me just mark it out right here. So I'm on the 50-minute candle and you can see that there's a high and there's a low of this 50-minute candle. And in this area, this is a premium and this is a discount. So ideally, what do we want to do? We want to take a long on the discount area and we want to take a short on the premium area. Premium discount. So just check out this trade, this price action. It goes down, it goes up into premium, and it takes a bearish direction because it's in the premium. It goes down to the discount area. Ideally, where you want to take a trade is on one of these both sides, to the opposite side. So what is equilibrium? Equilibrium is the balance of the market. So in equilibrium, there's a premium and a discount, right? So in the premium, you want to take, this is the premium, and this is a discount. In a in a discount, ideally you want to take a long, and in a premium you want to take a short. So you see what the market is doing right here? I put this wrong. This is the high of it, and this is the low of it, and is the equilibrium in the middle. So you want it to pass over to the premium for you to take a short into the discount. I wish I knew this when I first started because I was in a lot of Discord groups and Signal groups and Telegrams, and nothing worked. It worked for a while and then it broke. It worked for a while, then it broke down. Why? Because it's still me versus me in the market. Trading is not a group thing. And when I realized, like, we all get into this because of the money in the beginning, right? But if you really can, like, remove yourself from needing the money, like, think about it, like, how much money do I need for an entire year? Like, save up something, keep the money to like focus on your expenses and not having you think about them, and just focus on learning the skill of trading. Because if you learn this, you're like a walking ATM. It doesn't matter where you are, as long as you have a phone or, in my opinion, a computer, you can make money because you have the skill of it. So stop thinking short term. This I wish somebody said this to me when I first started. Stop thinking short term and start thinking on the long term, on the long horizon. I wish you nothing but the best. Have an amazing day. Let me just quickly explain what a break of structure is. A break of structure, the candle, the wick, I'm sorry, the wick of the candle needs to be closed on the body of the candle next to it, right? So this is not what a break of structure is. This is not a break of structure. Why? Because it didn't close on the body of the candle next to it. So this is more likely a break of structure. Why? Because the wick of this candle closed on the body of the candle next to it. So the wick of this candle closed on the body next to it. This is the definition of a break of structure. This is how to not spot higher highs and higher lows. I see people do this, like higher high, higher low, higher high. It doesn't work that way. You're missing all the candles, like, and especially on higher time frames. This, like, every candle has data in them. So you start here, higher high, higher low, higher high, higher low, lower low, lower high, and lower low. This is how you do it. And it's just grab a drawing tool and see where the market is going. See where the higher highs and higher lows are. Don't miss out on the candles. All right, good luck. Equilibrium is the balance of the market. So ideally, what we want to do is we want to take this area is the premium and this area is the discount. This is what we ideally want to do. We want to take a long on the discount to the premium area, and we want to take a short on the premium to the discount area. So you see here in the market, this is one example I can show you. You see here the market goes up, enters the premium section to drop back down to the discount section. This is something I wish I knew, that I didn't need to take the big risk reward trades when I first started. So let me give you an example. So this is the higher high, higher low, and what is the market telling us right now? It's telling us that it's going up. We are bullish. So what do I want to do? I want to mark out the low right here and the high right here, and put the 50% mark in the beginning, in the middle. Sorry about that. I want to mark out the equilibrium of the move. And what do I want to do? I want to see the market go down and give me a reaction here. And this is where I want to take a trade. Do I want to take a trade all the way up, continue in? No, I want to take the trade on the 50% mark of this area. Why? Because I want to have more chance of the market going to my area than to go into my area, hitting my take profit and continuing that way. See what I mean? So I'm just looking for the small moves every single day in the market. Today I met a guy at the gym. Let me share a short story and how this is compared to trading. And he told me like, I'm doing right here, I'm doing wrong here, and I look at the guy and he's overweight, right? He has a stomach. He was African. He was from South Africa. I like the energy. It's the same thing with trading. Like people trade supply and demand. People trade smart money concepts. People trade, I don't know, the orb. Like you see new names every time. It's the same things, but they change the name of it. And in my perspective, where I come from, does it matter really? Does it work for you? If it works for you, keep doing it because we all have different personalities and we all have different limiting beliefs and fears and greed level that we have. And if supply and demand works for you, great. If the smart money concepts worked for you, great. Keep doing what works for you. What's the saying? Don't if it's not broke, don't fix it. So don't fix it. And don't tell other people like you're wrong with your strategy because this and this. If it works for you, it works for you. That's about it. This is my plan on how to grow on social media. And if you disagree and you have more information, let me know. So my plan is like this. I do 10 videos, right? I do 10 videos. One, two, three, four, five, 6, 7, 8, 10. Let's say it's 10, right? Two of those videos will get a lot of attraction. So what do? I take these two and I make the same, not exactly the same style and same message of these videos, and I make 10 of these videos. And when I make 10 of these videos, 20% of those will get a lot of attraction. So what I do, I'll take these two and I make 10 of those. And I keep going like this over and over again. I take these and I keep going over and over again. Good idea or not? This is what I'm learning right now, and I'm here to share it with you. This is something I wish I knew when I first started trading. The liquidity is where the power lies. This is a regular S&P 500 week. So let's just mark out the highs and the lows of the market. So this is a Monday. The Monday created a high. So this is what happens on a Tuesday. The market opens, it takes out the high of the previous day, and then it continues down. And what happens on Tuesday? It creates a new high right here. And what happens on the day after that? It market opens, it takes out the high, and it drops back down. You can still make money on this, and it creates a new high. And what happens on the day after that, on a Thursday? Market opens, it takes out liquidity again, and it drops back down. And this happens over and over again in the market. Did you know that there is free indicators in TradingView, free strategies that you can follow in TradingView? If you just press on indicators right here, you write strategy, and you just choose one. And this is the way that you can also automatically backtest the strategy you're working with. And down here you can see there are long positions, there are short positions, long exits, short exits. And if you go down to this area right here, you can see the profit factor. You can see how much the win rate, or how many total trades it took, how much the win rate is, and many how the profit factor is regarding to your risk. So you can do all of this. Like, you can, as long as you follow proper risk management. And there are a bunch of them. There are so many free strategies on TradingView that you can use. Just find one that works for you and go with it. This is for my smart money concept traders. Does it matter if the fair value gap reaction is before the break of structure, before I enter? So let me show you this on the chart. So you have liquidity sweep, right? It swept the liquidity. What happened next? It didn't break structure, yet it entered a fair value gap and gave us a reaction off of it, right? But it didn't break a structure. It didn't do a break of structure. Do we still enter? No. We wait for a break of structure and then we enter. So what happens here? The candle closes over the body of the candle. We put our stop loss under the fair value gap or during on this liquidity, and we enter the trade. So does it matter if the fair value gap is happening before the break of structure? No, it doesn't matter as long as it gives you a reaction off of it. So you have a problem finding your bias and where the trend is going. This video will simplify it for you. So let's take this is on NQ. Just keep in mind, higher time frames hold higher power. The higher the time frames, the higher the trend accuracy will be. So if we go to the 1 hour on NQ, this is pre-market and this is market open. This is what you should look for. You should look for a break of structure to the downside or to the upside during the range. There is an overnight range that happens every night, right? Asia session, London session, New York session. Depending on the session you're in, you mark out the range and you find the break of structure that's happening. If it's a break of structure to the downside, what does the market likely gonna do? It's gonna go up, take out some liquidity, and then fall back down. Obviously, this is hindsight, but it works. That's how it works. See? Break structure to the upside, and it's more likely to go to the downside, and it's more likely to go to the downside. It goes up, takes out some liquidity, and continues down. Good luck, and ask me a question below. So if you have a hard time figuring out where the market structure is, where is the bias? How do I set up my bias? Here's a simple, like no-brainer way to find it out. Let's find something simple. So the market opens here, right? I have pre-market marked out and market open marked out. So this is what you do. The the high of this candle inside the range, if it breaks structure to the upside, what does that mean? It means that it's going up. It means that it's pointing up, right? It has a break of structure. It has another break of structure here. Break of structure, it goes down, it breaks structure. And when the market opens, this is obviously hindsight, but when the market opens, what is the market more likely to do? Continue up. Perhaps maybe go down, take out some liquidity, and then continue up. So your overall bias should be bullish because it's a bullish break of structure to the upside. Good luck. We are searching for liquidity always in the market. Like liquidity is where the strength lies. And when you start seeing that, like my mind got blown the first time I saw this when was first starting. So this is the a regular week on S&P 500. Every day has a high and a low. So what does the high do? It creates the high, right? The day after that, market opens, it takes out the high and it drops back down, and it creates a low and a high on the next day. So the next day creates a high. What happens on the day after that? Market opens, it goes out, it takes out liquidity, and it drops back down. And the next day, the same thing. It creates a high, the next day opens, it takes out the high, and it goes back down. The same thing happens with the lows and the highs. And when you start seeing this, you start having a good intuition and a market feel of where the market is going to go. Probably to the liquidity to be taken out. Good luck. I wish you nothing but the best. Have an amazing day. I wish I knew that I didn't have to take the big moves when I first started out. So let's give me an example. Give you an example. So this is the market structure. Okay? Where is the market likely going? Right? I'm bullish. Right? The market is going up. I'm bullish. So what I want to do, I want to take a higher probability trade because I wanted the market to go down to this 50% mark for me to take a bullish trade. So I take a trade right here, right? It takes out liquidity, it does the thing it wants, and it goes up. And I want to take it to the 50% mark of this leg right here. Why? Because the market, like I'm not looking for this move to happen right here. The market might shift and go down. And I want to take the opportunity to take a little piece of the market every single day. Good luck. So if you want to find what time market opens in your country, this video is for you. So the first thing you want to do, you want to write baby pips and search for that website. And you want to write your time zone. If you're in London, Berlin, or Kabul, you can just write that in, and it will automatically change and show you what time London session opens, New York session opens, Tokyo and Sydney. So I'm just focused on London session and New York session. And you can also see how much volatility it is during these sessions. So the New York has the largest volatility time during the New York session, and the London session has less, and Tokyo session even less. This is how you can find the New York, London, Tokyo, and Sydney market open and trading hours in this website. You know, when you hire a personal trainer at the gym, what do you want the personal trainer to do? You want him to teach you some things, to be there with you, watching you do the ropes and watching you exercise in the beginning. But your personal trainer's job is to work himself out of your life. It's the same thing with trading. Like we can't be inside discords or telegrams or communities and trading together. We have to. I get it. It's a lonely game, but you have to remember like why did I started this? To learn the skill of trading. So you have to remove yourself from these groups and do it by yourself. And eventually in the future you can start your own group, but you will not be that affected of it. Why? Because you already have the skill. You know what works, you know what works for you and doesn't work for you. You know which day to trade and what day to not trade. And the more you do it, the more confident you will become, and the more of a leader of your trading you will become. Good luck. Wish you an awesome day.